Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of AmeriVet Securities. And as always, I am joined by my partner, CFA, all things rates, Fed, and liquidity, Gregory Faranello. Good morning, Gregory.
Good morning, Michael.
Well, here we are again, up against the Fed, and it seems like it's an important meeting again. A lot going on, and for those who follow us, know that I love the repeat guest. So we are very, very happy and grateful for your kindness, Priya Misra, for joining us today. Priya joins us today from JP Morgan Investment Management. So great to see you again, Priya.
Thank you for having me.
Okay, so there's a lot going on. This is a fluid situation. Rates for longer, maybe even signs of maybe rates higher. I don't know. But I always say this. My mom raised smart children, so I am happy to hand it over to the experts and stay out of the way. Greg, I hand it over to you. And again, Priya, thank you so much for your time.
Thank you, Mike and Priya. It's great to see you, and thanks for being with us again. You know how we like to do it here. We're going to dive right into it, if you don't mind. And we'd love to get your outlook, for the meeting, your view in terms of rate cuts, maybe a little bit on QT at the same time. What are you thinking here as we head into this week's meeting?
Sure, and thanks for having me on again. It's a big meeting because the December meeting sort of set the stage for rate cuts sometime this year, and then we've had data that should not have given the Fed a whole lot of confidence. So, I should start with, we don't expect any action per se, but we think it's going to be a highly action-packed meeting because there's a lot of clues that the market's going to be looking at. So we don't expect a rate hike or cut at this meeting. What we are looking for will be the dot plot. Remember, this is that March meeting where we are going to get the statement of economic projections as well as the dot plot. And I think a lot of the market focus is that 2024 dot. And what does the median dot suggest in terms of rate cuts this year? Now, remember, in December, the median dot implied 3 cuts, so 75 basis points of cuts this year. The market, and we'll talk about market pricing, but we're right around there. But we're all focused on, is the Fed going to suggest 2 rate cuts? And it takes only 2 dots really in the 2024 bunch of dots to move that median from 3 to 2. So, I think it's up in the air. I think there's a decent chance that it does. But I think my base case is that they actually leave it around 3 cuts for this year. I think there's been 2 months of data, and we know there are a lot of seasonal distortions with the data of December, Jan, Feb. I think the Fed is going to need a lot more evidence to say that the progress on inflation that they cheered, that every market really cheered at the end of last year, that is stalling or going the other way. So I think they leave it at 3 dots for this year. There's a decent chance, 30-40% chance in my mind, that can move to 2. The other thing I'll be watching for is a long run dot. I think it matters a little less, but it will open the debate for what is R-star, what is neutral rate. When we start talking about the 10-year, all that matters a lot more, because does it really matter whether they cut 2 or 3 times this year? Not really. It's the total amount of cuts. And so if they tell us that the end point is actually much higher, remember that dot in December was 2.5. Does that move up to 275? I think it will have an implication for total amount of cuts, but I will highlight the market's price for 375. So the market's already thinking that the long run dot is higher, but we'll be watching for 24 dot. Obviously, they're going to give us 25, 26, but I'll be watching for that endpoint. And then, as you said, QT. We know Chair Powell told us in January that they'll be talking about QT. Do they actually make a decision? I mean, this would be the time after the Fed meeting, they could announce something about tapering that QT program. If they don't, I think we'll be watching the press conference. What does Chair Powell say about QT? Are they close to tapering? What are the things they're watching for? Do they need to see stress? My sense is they don't want a repeat of September 19, but do they bring that up and all of that? So it's not so much the action where we actually don't expect a lot. The dots, the messaging from Chair Powell, I guess last week he said we're not far from getting confidence. Does he repeat that? Or does he acknowledge that the data in the last 2 months reduced some of that confidence? So I think that's why there's a lot in this meeting that could move markets.
Thank you for that. It is interesting. We went from over 6 rate cuts priced in to start the year to managing that down now to 3. What's your sense relative to market pricing right now with roughly around 3 rate cuts starting in and around June? What's your feeling on timing and sort of curve structure right here? You think the market has it right, or are you skewing a little bit different than where the market's moved to over the last couple of months?
So I think the market's been actually driven by the tails in a way. I think at the end of last year, early this year, the market was dragged to pricing in, as you said, 6 cuts this year because of that tail of a hard landing. Now that seems to be reduced. In fact, now with inflation coming in a little higher, growth being resilient, I think the probability of a recession has gone down. The probability of a reacceleration has gone up. And that's why now we're pricing in 3 rate cuts. I would actually say the market's very well priced right now for this lack of conviction on whether it's 2 or 3 rate cuts. I mean, it's hard to know. When you look at the options market, I think there's a decent chance of 2 cuts being priced in. Now, you might say, well, the market's pricing in 3. But I would argue there's always an asymmetry. If the Fed cuts twice and the dot plot suggests 2 cuts, you should price in a decent chance. So there's a third one. Once they start, they're not hiking. And some slowing in growth or tightening in financial conditions can make them cut more. So I think we're pretty well priced for a decent chance of 2. If they do end up with 2 cuts for this year, I think we can sell off a little bit, 5-10 basis points. And I think if we end up with 3, and again, there's a lot. If we end up with 3 cuts, but Chair Powell says, well, I need a lot more confidence, or we might cut rates late this year as opposed to in some time, I think then you can actually, you can rally 10 basis points. So I actually think you've got a 10, 20 basis points on either side that we can move. We're well priced for this lack of conviction that the market's operating when it comes to the Fed reaction function. Sorry, you asked about the curve. I think the curve has flattened a lot. A lot of that, I would argue, is negative carry in steepness. The steepener is the right trade when the Fed suggests imminent rate cuts. If that's 6, you talked about markets pricing in June, July, really for the first cut. If we're still that far away and maybe the July gets pushed and then we have the election, maybe instead of July, it's December, well, then it's too early for steepness. So if you think they're going with 3 cuts, I think we can have a knee-jerk steepening. I still don't think the steepener is the most efficient way to play for slightly dovish or a Fed that's still ready to cut rates. I'd rather be long 5s or 10s than have a steepener on. They both should work with a slightly dovish Fed, but I think that steepener, that negative carry just hurts. So we're fairly neutral on the curve here.
Yeah, no, that makes sense. It is a game of timing. We came into this year, I think at one point we had March price for 100%. We've just kept kicking the can down the road there a little bit. I want to go back to, you mentioned financial conditions. I'd like to go back there briefly if you can. I mean, financial conditions, the markets have been wide open. We see all the deal activity. Obviously, rates have come down relative to October. Credit spreads look great, have tightened dramatically. Equities have done really, really well. Financial conditions are really, really tight, loose now. Do you think that plays into the Fed's mindset with regard to conditions being loose here relative to their potential pathway in terms of rate cuts moving forward?
Sure. Great question, because I think with every Fed meeting, the Fed overall communication, including the press conferences, this delicate dance between the Fed reaction function and financial conditions. So I'm sure they pay attention to it. But a few points I'll make. I mean, we talked about how the rates market is pricing in a decent chance of potentially only 2 rate cuts. The equity market or risk assets are on a tear. I mean, I think some of it is better economic data. Some of it is the Fed that's suggesting they're still going to cut rates. And maybe they start a little bit later than what the rates market had thought, or they cut a bit slower this year, but they're still going to cut 150, 200 basis points as the rates market's pricing in. And so risk assets are very much in the soft landing mode, and that's the easing in financial conditions that we've seen. But I would argue the Fed views financial conditions as context dependent. We've had better economic data, a resilient consumer, the labor market's moderating, but we're not nowhere near the signs of a recession. So I think the easing in financial conditions, the Fed would actually likely justify based on the economic data we've had, which is okay, slightly hotter than expected inflation, but nothing suggesting, that it's really the entire progress is getting reversed on inflation. Now that is a risk. If inflation stalls or heaven forbid starts to go up from here, I think then financial conditions immediately tighten and risk assets struggle. But let's say the path to 2% inflation is just bumpy and we're still heading lower, which is our view. Growth remains resilient. I think the easing actually is very justified. So I don't think the easing, to your point, financial conditions are extremely easy. I don't think that makes the Fed go hawkish given the data we've seen so far. You fast forward to May or June, and we've had further easing and inflation going much higher. I think they'll push back, but I'm not sure with at the point where the Fed has a lot of confidence that the inflation progress is getting reversed.
No, thank you for that. It makes sense. I mean, Chair Powell certainly hasn't pushed back on the easing in financial conditions. If anything, I mean, he created a lot of these dynamics toward the end of 2023. As you pointed out. And I want to just end here and go back to QT, if you will. I mean, timing, we could get more clarification at this meeting. And then also maybe a thought on composition, because there has been some talk in terms of the Fed wanting to get into all treasuries, in particular, ramping up on the T-bill side. And then we have the MBS roll-off, which has been slower than expected over time. Any thoughts that you might have there?
Sure. I'm glad you bring up QT because it's often not thought about as much. As former Chair Yellen said, it's like watching paint dry. It is until it's not, as we all remember September 19. And I think the Fed really does not want a September 19 type scenario. They've put the standing repo facility in place. I think there's still stigma in that facility, and it's not large enough to prevent if reserves do go below minimum. Now, nobody knows what minimum is, including the Fed. I think it's been excellent that they've said there's a wide range there, and that therefore tapering QT at some point, whether it's this meeting or the May meeting or the June meeting, I think we're within the next few months, they're going to announce tapering of the Treasury QT. I think mortgage QT continues as earlier. And, I don't think they want to increase any mortgage portfolio. So to your point, I do think they want to move to a Treasury only portfolio. Except remember, some of the mortgages they own, the 2%, 2.5%, they're staying on the Fed's balance sheet for a long, long time. I don't think they're going to sell mortgages, but the mortgage percentage will continue to decline. The T-bill one, I'm a little bit more torn. There is so much demand for T-bills, and the Treasury is issuing 15 to 20%. That's the T-back recommendation that the Treasury sort of endorses. I don't think there are enough T-bills. If the Fed moves into T-bills, as well as the 6 trillion in money market funds, some of it goes into T-bills, we don't have enough T-bills. So unless the Treasury changes its T-bill issuance, which they might, they're independent and they might decide, well, we need more T-bills than 30-year. I think then the Treasury, the Fed might change their plan. But my thought is similar to what they did in 2019 when they stopped QT. They bought across the curve in proportion to what's outstanding. So they are not favoring one part of the curve against another. But I think that's really a step for when they stop QT. My sense is in the next couple of meetings, they announce tapering. And then by the end of the year, I think we'll be at, and watch RRP for that. RRP is now 400 billion. I think the reason they should do it sooner rather than later is once RRP drops below zero, that cushion for reserves that the Fed has goes away. And then it'll matter whether minimum reserves is 3 trillion or 3.5 trillion. So let's finesse that. That's the argument for tapering QT. President Logan's brought it up. And so they're going to taper QT, I think, over the next couple of meetings. And then by the end of the year, we think we'll be close to minimum reserves. They stop QT. And then your question comes up, where do they buy it? I think they buy across the curve.
Interesting. Yeah, it seems like, and thank you for that. It seems like let's get the overall level of balance sheet right first, and then worry about the composition over time. But Priya, this has been fantastic. Thank you for all of your insights and joining us today. And if you don't mind, I'm going to pass it back to our co-CEO, Michael Naidrich.
Thanks,
Thank
Greg,
you.
and thanks, Priya. The name on the door may change, but the quality advice and guidance certainly does not. So we are certainly appreciative of that. Greg, thank you again. You know how much I enjoy doing this. It continues to be a major focus of our clients. If anyone has any questions, please call your representative, then we'll be happy to have Greg jump on a call or visit with you. So thank you all. I wish everyone a good week ahead.
Thank you.